What you're looking at, sorry to burst your bubble, but this is not real money, right? These are fake notes. I don't think any youngster, you'd find it hard to find a youngster on some street in India actually counting through notes like that. Why? Well, you know why? It's because of UPI. But I have a question to ask you. What if you knew about UPI months or years before the technology actually became mainstream? Are there interesting business ideas that you could tap during that period? Would it have opened some opportunities for you if you knew about demonetization before it came? Would it have been useful for you? I personally think that no matter who you are, it is always useful to know about how new technology that governments will end up using 6 months to a year before it actually gets implemented. That way, no matter what the shocks are, you are ready in this. So, in this video, I have my hands on a report by Bloom Ventures. This report is co-authored by Shendu Panigari and Ashish Fafia from Bloom. And this report is interesting. It's a little bit controversial, but there are lots of business opportunities and ideas because it turns out that a lot of governments across the world are tired of the existing banking system, especially international transfers, and many of them, including India, have run pilots and trials with a new system. This might make UPI look like old news. So, ladies and gentlemen, without much further ado, I introduce you to the report The Future of Money India's Tryst with CBDC. So, before we proceed into this report, I need to talk about something that is a little controversial, and it's controversial because of a reason that brand managers understand, but the average public and especially technologists don't actually understand. You can watch a video 20 minutes long or read an article 5 pages long. A day later, you'll remember maybe 10% of the information you read or watched. 6 months later, you're only going to compress it down into 3 or 4 words. The brain, is a great compression engine. So you'll read something big, it'll compress it down into small sets of words, and brand managers know this very, very well. If they are writing an ad, instead of pitching you all the features of the product they're selling, they're selling, they'll compress it down to one jingle that you can just whistle. For example, Pepsi and the Dil Mange More campaign, or Mountain Dew, right? डर के आगे जीत है, and Nirma washing powder Nirma, right? So brand managers understand this, that a few months later you're going to forget all the benefits in the ad. Your brain is going to compress it down to 3 words, so they need to have the most ready jingle for you to sing along to you, so you know which set of brand managers in which. But do you know which set of brand managers in which industry failed at this? Well, it's the blockchain industry. The blockchain, from an engineer's perspective, and I'm going to talk from the computer science perspective. So, by training, I did it for years of my life. It's fascinating, but I think there are two parts to this one. Is that you know why is it? It's because blockchain is actually complicated, and you cannot reduce it down into a jingle very easily, especially when you're explaining it. And second is that this technology comes also with a set of people, primarily because it's a bunch of young, ambitious software engineers in the industry. They're all very ideologically driven, and the ideology of blockchain converted it from something that it could have been very useful for a lot of people to something the people's brains just compress down to 1 or 2 words, right? For example, scam, scandal, fraud. So now I don't think it's fruitful for us in this conversation to go down the ideological side of things because it's very subjective and based on the opinion. But the technology side is something that people have forgotten, but governments are not. In fact, lots of government, including the Indian government, have been relying on this technology for the next wave of finance. They don't care about the ideology, they don't believe in the idea of decentralization, but they definitely believe in the idea of faster transaction times and less painful bank work. And this is what this report and CBDC is about, which is a classic example of this, is the chief financial officer of the Monetary Authority of Singapore, who responded in one word replies to two questions. The first question was, when asked to him, was, do you think, uh, what actually do you think of cryptocurrencies? So his one word response was overrated. And then they asked him, what do you think of blockchain? And his response was underrated. So the report asserts that while cryptocurrency in general and Bitcoin in specific may not necessarily represent the future of money, it can be viewed as a digital asset or a store of value. And I do believe that the true driver of innovation will actually be blockchain and the distributed ledger technology, because it actually makes the current, the very complicated banking system much simpler to actually execute, especially across countries. And the report has an interesting claim that central bank digital currencies may actually be the future of money. The report believes that they are definitely poised to replace digital cash as long as they're actually backed by banks. So there is a lot of benefit in this technology. In this video, we'll go over a lot of things including distributed ledger technology, cryptos, and even things like deposit tokens, which were actually recommended by a bank, which is JP Morgan and Chase. But before we talk about the future, money, let's pay a little bit attention to the history of money. How did we even get here? So so let us actually first understand what it is. All right. So let's say there are two families. One family was great at growing crops. Let's say they were great at growing pumpkins, and then let's say there's another family. Let's say they've been really good at making chairs. And between generations, father to son and father to son and father to son, the skill of making chairs and the recipe of the secret of the recipe has been passed down. So down, maybe today this family wants to go out and eat pumpkins, and maybe they want to make pumpkin soup today. So how are they going to acquire the pumpkin? So how are they going to acquire it? So they will need to walk all the way to family one and say, hey, would you like to take one chair? Maybe you need a chair. Maybe you need to sit down. But for the chair, you can give me 10 pumpkins in return. And depending on the number of people that were actually willing to exchange pumpkins, the number of other people that actually could be able to make chairs will vary. So the need and the demand for chairs and pumpkins is what is how a markets get created. Now, obviously, if somebody selling a chair and they specifically want a pumpkin, it might be hard to find that pair. For example, I have a chair and that person has a pumpkin. What are the chances we'll come across each other? There were no bikes, there were no cars, there wasn't some internet where you can make a purchase. So finding these people was hard. So all the people sat together in the village at 8 a.m. every morning. We will come to this town square. We will call it a market, and everybody that wants to sell or buy something, you come there at the same time. Even if you were not able to find somebody that was selling pumpkins, you were able to go to the market and there a few people selling pumpkins. And because there are multiple of those people sitting next to each other, you get what is the fair price for the pumpkin. Right? Now, obviously, if you're selling pumpkins or chairs or anything else, I think carrying them around all the time is a pain. Right? And everyone needed a convenient object that they could keep around with them all the time, so they didn't actually have to lug it around, right? Whatever expensive things they grew or made. And this object was the first primitive form of money in the early days. So believe it or not, this was a seashell. Alright. So seashell was a form of money. So people used to say, well, you know what? We've got this seashells, and this seashell is worth 3 cows. Or this seashell is worth whatever, 5 chairs. Alright. And between all of them, they'd agree on what the rough rate was in fact was. Alright, in the morning. In fact, it's almost like they had this giant board in the middle of the market where they would draw with their primitive tools, saying that where 3 chickens is equal to 1 seashell. Alright, so that is like the exchange rate. Or what you would know is the price of chair, and so you'll be able to collect enough seashells, and then you'll be able to afford the chair, right? As you know, the exchange rate. But the seashell thing became a problem because a lot of expert swimmers realized they don't actually have to make or sell anything. They could just go swim to the other side of the bank and collect seashells, and they would become infinitely rich by hacking the system. By finding that medium of exchange and just saying, I will directly hold this, so people realized, right? So people realized that we actually need something rare, alright? Something which is not there in this world. That should be the mode of currency, alright? Something which is not abundant. So what we did was, uh, in this form where people can't easily cheat and obtain the object itself, and so that object, that rare object, was first silver, and then it became gold, and eventually gold became inconvenient, and the rulers became a little bit greedy as well, and they said, well, instead of any gold being viable, why not us make our own coin with our own seal, our own transcription, and that will be the going currency of this kingdom. Eventually, as we learned the techniques of printing, we just chose to go with a more convenient format, which is paper money. Eventually, modern people like you and me decided we don't even need to have paper money. We have these central banks. We can just leave our money in the bank, and we can have something that represents the amount of money we have in the bank. The main reason for this was theft. If I just kept money in my house, somebody could come rob it. So, the more money I have, the more convenient it is for me to go to a bunch of gundas, or as banks, right? We are calling banks gundas, but that's joke. Uh, and we tell these banks, keep all my money. We will write on this piece of paper how much money I own, and you keep it safe. It's your responsibility to have the guns and the gundas to keep the safe from people. And whenever I want to transact with somebody else, I'll use this interesting new device called a card, where you automatically deduct from how much ever you're holding with all the other banks and the gundas. Eventually, uh, whether they are national or international. Alright. So eventually, cards were still a single point of failure. They could still get lost. They're still a little bit inconvenient. So to use OTPs could still get stolen. And people started carrying around mobile phones at the same time. So eventually people said, I have a mobile phone, I have a card, why shouldn't these two be the same thing? And that led to the concept of electronic money. Now people had started making transactions internationally, and that's a difficult problem because the gunda sitting over there had to coordinate with the gunda sitting over here, right? And they had to send the money across without you having to be involved, right? So people eventually realize that these gundas are no longer gundas, and they are actually really necessary for us, uh, and we should call them banks. We should give them rights and powers, and we should regulate them and make sure that while they are transacting, they are able to transact with us, knowing exactly what's going on. And that is why digital currency comes into play. In fact, the idea behind cryptocurrencies, the original idea from Mr. Satoshi Nakamoto, was that we actually don't need these banks, aka gundas. We can just transact among ourselves, and all of us can make sure we have the ledger. So, anytime a transaction happens, all of us can write down that transaction on the ledger. So, even if one person decides to manipulate the records, we can look at that person and we can tell that person, you're maintaining the wrong records, and kick him out of the loop. And because a lot of people are spending time and energy writing down each of these transactions, we give them a small fee. Alright? It's like a convenience fee to make sure that we all know who's transacting money with whom. But more importantly, nobody has to actually manually write there what's going to be an automatic, right? It's going to be an automatic software sitting in all of our computers that records every transaction that happens in the network. It's a very interesting concept, and this is also ideologically driven because a lot of people, a lot of these people were pissed off with the 2008 banking crisis. And here's where the dissonance starts kicking in the technology. So the technology is great. The idea of all of us keeping our own distributed ledgers and the technology to actually facilitate instant transactions was all very valuable. But the ideology of the fact that we don't need these financial institutions was probably a bit flawed. And as we all learned during the crypto wave, people make a lot of stupid mistakes. Sometimes you might transfer money to the wrong account. In the case of banks, they actually help you out with this. But in the case of most cryptocurrencies, there's no one really there to help. So people realize we actually need these people because when we make mistakes, when we transfer money to the wrong accounts, or we make a mistake, or we forget our password, we have somebody there to help. So a lot of people understood this, and unfortunately, along with the ideology, they also threw out the technology. But the technology, like I said, is still valuable. And as we continue to learn and grow as a species, there will be obviously be new forms of money that use the goods of the technology while keeping away the bads. So I have a question. So what is the actual use case of money? So the concept of money is like an IOU, right? It's a thank you for the pumpkin, right? I owe you something, here's money. And you can take that I owe you and you can put it back in the world and get what you want. It's like this circulating I owe you that we can just keep transferring between people, but the actual use cases of money are not just one, right? There are five. Alright, what are the five use cases? The first one is that money, it can be used as an asset. Number two is that money is also a store of value. So, in the past, a lot of people ask questions. Well, why can't we take this bottle of grape juice and use that as a money? And the problem with the grape juice is that you can actually drink it, you can consume it, but if it gets spoiled, it gets destroyed. But the money has a much larger long and a longer lifetime. As if it's well maintained, it still stores the value for centuries. And number three being is that money, it can be used as a form of currency, including local currency, which is if that I have an Indian rupee, that allows me to exchange both with the people of my own locality as well have some form of conversion rate with people of other localities and other currencies. Number four is that money is actually a unit of account, which is that I think I can track my own debts as well as the debt of others to me in one place. With that object, lastly, fifth, money is a medium of exchange. If I only want to transact and buy that pumpkin for my chair, instead of doing it directly, I can use this medium called money to make the transaction simpler. And obviously, out of the five things, four are reasonably easy, but there is one concept of money which is transactions locally and globally. So, when you're making a transaction between countries, that is actually complicated and painful. The average compound annual growth rate here is 88.2% worldwide, which is led by Asia Pacific. So it seems to be the most important for us, according to a study by Capgemini, that by year 2026, new payment methods will take over, which encompasses instant payments, e-money, mobile and digital wallets, which is DT, QR codes, and all of these have to be in perfect sync with each other. So you can't have a transaction that works on one wallet in a certain way but doesn't reflect in another wallet. That is going to be very scary to the user. And mainly cross-border revenues remain concentrated in business transactions. Consumers transacting abroad is a big number, but in terms of quantum, uh, nothing beats an Infosys from India getting a $10 million deal from some company outside of the country, and that happens all the time. Here it is in numbers, alright. 23.5 trillion flows in cross border transactions in 2020, and that is a massive number. So, the transaction cost for this massive number is 12 billion. It is so large that it eclipses almost every industry sitting in India. In fact, 12 billion is one third of Singapore's GDP. Next is that the settlement time. Unlike UPI, it's not instant. It takes 2 to 3 days to clear a cross border transaction, and the settlement type actually depends on the kind of transaction. I mean, when you were younger, you must have thought, right, why does some bank takes a lot longer than other types? For example, when I swipe a credit card, why is it instant? While a bank transfer takes 3 days. It didn't make sense to me back as a 20-year-old freelancer when clients in the US were paying me. I was like, why is this supposed to take time? While some other clients can get it done instantly. In fact, the speed of cross-border payments are easily displayed here. Credit cards are instant, as I just told you. International wire transfers can take up to 2 days, and some things like conventional bank transfers can take between 3 to 5 days. A lot happens in 3 to 5 days. Markets can crash, exchange rates can change. The longer the time it takes for something to go from one place to another place, the more chances of things coming in between. So that change the dynamics of that transaction. And last, two especially e-wallets and bank transfers are something that can actually be changed by blockchain and distributed ledger technology. And actually, sometimes when I think about it, it boggles my mind that every bank has a different system. Every country has so many different banks. It looks and seems like a complete mess on top of that. There's a foreign exchange rate as well that confuses everything in the middle. The report says that there are 7 challenges in this entire play. Each one of these 7 is a business opportunity for you. Number one, for example, it's fragmented data, right? Formats. So obviously, a data format of some random bank in India and some random bank in Brazil are going to be completely different. In fact, there's a ridiculous number of things and laws and whatnot that could be different. Number two is the compliance checks. Especially after the 2008 crashes, compliance everywhere got much tighter. So every bank everywhere has to comply with the local laws and rules and bylaws and country laws and international laws. So it's painful. Next is that the banks actually have limited operating hours. Many of these transactions even today are manually checked through, which means that a person needs to be there from 9 to 500 banks obviously don't work on the weekends. Alright, so a lot of businesses across the world have worked with some banks in the past, and I wouldn't want to do that again, right? Where we would want to be dealing with banks. Plus, I don't think I can do it again because all the engineers you hire today who are writing legacy code for the banks have a very different skill set. They have a very different understanding of frameworks and technology compared to what banks are currently use. Not only that, all the APIs they are dependent on are too old, are not well documented, and you need some guy who has been at the bank for 20 years to know the context of what actually happened and what decisions were made back then. Next is that all this actually reflects in fees. Every bank takes a small cut, especially as a transaction moves from one place to another. There are lots of intermediary banks, and these people take their transaction and cuts otherwise and cuts. Otherwise, it's not valuable for them. And next is obviously the legal issues. Banks and the bank employees can be responsible in certain cases, so they need to be careful. And last is actually a human problem. No matter what you do, you can't remove um, all the gundas out, right? There will still be a little bit of gundi left. There is a perverse incentive for banks to hold on to that money because, as you know, the bank revenue model is based on lending. So, the more liquidity they have, the better it is for them. A market analysis by COP shows that the global premium charge to send payments across borders varies from 4% to a full quarter, that is 25% of a transaction, with a global average of 3.39%. And there's actually a significant number of what 23.5 trillion cross border flow that we looked at before now. Now let's go deeper. I think our goal here is to go as deep as possible. Let's double click on that 4 to 25%. What is it composed of? As you can see, there's payment options. There's nostro vostro liquidity, which is an interesting concept. So what it is when swift transfer happens between two banks, let's say the Indian bank and a US bank, each of those banks has both a local reserve as well as a reserve of the currency that's being transacted into. So the Indian bank will have some USD reserve, the USD bank will have some Indian reserve, and getting the liquidity on both sides, making sure both banks have enough balance is a challenge. The next piece is claims and treasury operations. After that, it's compliance, legal, and next is forex cost. And I have an interesting story about this. Hold on. And the last thing is network management and overhead. So all of these add up to make the fee hefty. So we we have to go on a website, right? And so when I was younger, the payment infra in India was pathetic. In fact, one of the only apps that most freelancers at that time used to rely on was something called PayPal. Alright. PayPal would take money from the international client and transfer it into your wallet. And I was excited. I was like, hey, I got get to sit at home and make money cross border. This is amazing. But what I didn't realize is that when PayPal used to actually settle with my bank and send me money, I always got screwed on the exchange rate. They'd pick one exchange rate out of a 56-day period. That was the worst. So they would send me less, their fees were crazy, and there's really nobody to complain to. Because I think at that time the PayPal India customer support team was like 3-4 people, right? So I didn't have any choices, and many other freelancers were actually stuck. In fact, I remember 5 years back, a lot of people who had um, uh, they had believe it or not, event we just had PayPal doing the same old techniques because PayPal has a choice to give you the lowest exchange rate, and this is called forex. And this is where a lot of middlemen make their money. In fact, the report even gets goes on to say that the SMBs are the most affected by this. And you know who gets screwed the most? It's not the people at the top or the people at the bottom, it's the people in the middle, as usual. So take a look at this chart. The larger the transaction, for example, if a transaction is over 100,000 US dollars, the average fees of the bank is $5. And if it's a medium sized transactions between $1,000 to about $100,000, then the average fees actually goes up to 6.8, and then it comes down again for small and micro. If you look at the actual bank margin, the smallest transactions actually end up losing the most percentage. It leads to a lower on average dollar value, but in percentages it's meaningful. And this is very interesting image that an actual breakdown of what happens when a buyer buys something from a supplier. Let's look at all these, um, and let's say there's a buyer in California. He sent $4,800 to somebody, let's say in Brazil. As you can see, first the buyer charges a transaction fee. Then there's a middle bank somewhere, um, in the let's say in Los Angeles, that charges a fee as well. Then it goes to a large bank. Let's say it's the large New York bank who is taking a $25 deduction. Then there's some bank in Brazil that gets the money in the first place. This is a multinational bank, and instead of taking a fee, they actually make money on the foreign exchange. So if the wholesale rate, let's say, is 1.6, then they're giving it to the customer at 1.5. This goes to the Brazil bank, then it goes to the end, and the bank of the supplier, where there's another transaction fee that's taken, and you add any payment gateway in between. These, for example, you add a payment gateway on the supplier side like Stripe, uh, or any others, and you take something that PayPal, that has multiple hops. There are even more middlemen in the equation. So all the gundas have gotten together. They have created a circuit where, just like brokers, right? If a broker finds one house, but he takes the help of another broker, they split between themselves. But it's time for change, and more commerce is international. More commerce is global today, and you need better systems than this without five middlemen and taking 5 days. You need something that's instant. In fact, in 2020, 43% of small businesses said that they will be doing a transaction online. It's almost half. It's almost like half the payments you do on UPI take 5 days to settle and have huge fees. So, how would you feel about it if that these businesses have a solution, and we've been able to shed some light on this in the past. So now it is blockchain technology. It's not about the ideology, not cryptocurrencies, but the actual technology that powers many of the chains that we have today. The idea is very simple. Everyone maintains an automated ledger. If somebody is putting nonsense on the ledger, you kick that person out. Every transaction is recorded on these ledgers, and with the newer technologies, especially the L2 chains, transaction times are nearly instant. So until now, the ideology has been that if we all are maintaining the ledger, why do we even need people in between? Why do we even need governments? But as we have all learned, government sitting in the middle, institutions sitting in the middle, add a safety layer. There are regulations involved, and that's not a bad thing. If your goal is to reduce uh, transaction times and fees, in between, the entire idea of the blockchain is that it kills intermediaries, and even though it will not remove them from the equation, it reduces the amount of time, energy, and processing fees that they have to put in. The way transactions can be quick and cheap, as you can see, the original Bitcoin still takes 78 minutes to complete a transaction, and Bitcoin with Lightning Network takes between 1 to 10 milliseconds. Ripple takes 4 seconds. And look at the transaction fee, it's a tiny number, and compared to banks, which take 3 to 5 days and $20 to $25, it is very clear which of the two technologies win. It's not even a 10x improvement in speed or cost, it's much more than that. And while a lot of people have come in with a lot of different use cases for the blockchain, and I can still think of a lot of use cases for programmatic money, I think the main use case will still be remittances. I want to transfer money abroad, I want to do it quick, I want to do it cheap, I want to do it without filling out massive forms. So this is the technology to enable that now everyone was gunning for, right? Bitcoin to be that. But I'll tell you the problem with Bitcoin and many other cryptocurrencies. They don't have true properties of money. It took us some time to realize this because you actually need these cycles to play out for a bit, right? Bitcoin is simply too volatile. In fact, Bitcoin has something called the Bitcoin volatility index, and you can see how volatile it is if you add in gas fees, congestion, right, block size. It just makes it unfeasible. But like I told you in the very beginning, money has 5 use cases, and Bitcoin is certainly showing signs of a store of value use case. Bitcoin fails when you need to use it as a currency. When you want high speed transactions in the volatility, uh, it matters, and that's not a good time to use it. But the main value of Bitcoin is that it actually educated the regulators, because until now nobody knew how this would play out. The technology seemed sound, there was a lot of ideology, there was a lot of good news and bad news about it, but none of us had any real world experience with it. So whenever you introduce something new into the world, you need to see how it plays out for half a decade or a decade. And before, Bitcoin regulators had no exposure to this. But after, Bitcoin regulators were able to see this play out for a bit, and now they have made their judgments a year, 2 years after the hype has passed. And the judgment is that blockchain is useful, distributed ledger technology is useful. It can severely reduce costs, and the future is that the technology behind it is something that should be applied to our regular financial institutions. More importantly, the technology behind Bitcoin wouldn't scale to the transaction frequency that we actually wanted. So there were other coins, we call them altcoins, that came in and proved that some of that was possible. Ripple was one of these, and the main reason that Ripple uh, didn't make its promise of that quick cross-border cheap transaction mechanism was actually because of regulatory challenges. The Ripple crisis emerged in December 2020 when the US Securities and Exchange Commission, which filed a lawsuit against Ripple Labs, alleging that this is an unregistered security. The lawsuit triggered significant regulatory scrutiny. It caused major cryptocurrency exchanges to delist or suspend XRP, and people forgot about it for a while. But believe it or not, in July 2023, which is 3 months back, Ripple won a partial victory in the case against the SEC. The lack of clarity surrounding XRP's regulatory status still poses a dilemma for market participants, and today, the win that Ripple has actually inspired confidence that regulators are not completely evil. Many people in the blockchain space have now been calling for regulation. They're all like, well, tell us the rules, we're happy to comply. But tell us the rule, and I think that is what the space was looking for. And there's a very interesting quote around this, that if we want our regulators to do better, we have to embrace a simple idea. A regulation isn't an obstacle to thriving free markets, it's a vital part of that, right? The cryptocurrency educated regulators on the power of these distributed ledger technologies. Hence, the central banks across the globe are leapfrogging and building out their digital currency strategies. The regulators have seen one cycle, and the serious technologists have seen this as useful technology, and they are willing to stage a comeback. In fact, 114 countries representing 95% of the world's GDP are exploring a CBDC, which is a central banking digital currency. 60 countries are in an advanced phase of exploration, which they are actually running pilots or a trial, or they've actually launched something. So these central banks are actually working with the BIS and the International Monetary Fund and other industry bodies to come up with a CBDC, which is not just a digitally native version of traditional notes. It's not just converting this online, but a completely new system that their current systems can interface with. And that system has to work flawlessly across all the countries in existence today. Believe it or not, countries like China, Singapore, India are actually at the forefront of this. And all three of these countries have actually run pilots. The current form of money looks like this, which is that the central bank has issued some money which is split into their own reserves as well as cash in circulation. Then there is universally accessible money, which is that any commercial bank has access to this cash. And between the reserves of the central bank and the commercial bank, you actually have digital money that all of us use today. But the future is going to look slightly different. There is a central part of this trifecta, and the central part is retail CBDC. While the bank's reserves are now wholesale CBDC, which is available with them in bulk to control the supply of. In fact, the World Economic Forum predicts that 10% of the world's GDP by 2027 is going to be tokenized. It's going to be some form of central banking digital currency that is freely moved across by all countries across the world. So the advantages are very clear. Number one, which is that you can design any monetary policy with these, and you can make it programmatic. Something like the tax that individuals pay can be deducted automatically. Any rules and the regulations that apply country to country can also be deducted automatically. For example, when you invest in equities abroad from India, there's something called an LRS, and this LRS can actually be automatically deducted and applied. So this means there's financial inclusion for a lot of underbanked or unbanked population who don't actually have access to the internet all the time. Real time payments easily detecting financial crime and fraud by cross border transactions, and obviously less space and less overhead cost of printing and moving cash. This paper, not the concept behind the paper, but this paper might be necessary in the long term. In fact, the idea behind CBDC is to build the best kind of stable coin possible. that is used for high frequency transactions, both internally as well as externally. And further to this, IMF has actually broken down the CBDC architecture into two categories. One is token based and the other one is account based. Token based works a lot like cash. It's supposed to replace cash. The central bank in India, which is the RBI, the Reserve Bank of India, is not going to be involved when I give 100 rupees in cash to another person. It can happen offline, it doesn't need the internet, and CBDC enables that it's a direct replacement to that. Even if the internet is not in sight, the second type that the IMF proposes is an account based system, which is, for example, your account on HDFC Bank, where you've done a KYC, you know the bank, and the bank is verifying every transaction. And this is exactly how it's going to work. You will need to go to a bank account and withdraw CBDC. It's almost like withdrawing this from an ATM, except you're not getting something physical. It's going to be on an app. And let's say in the morning, the app says zero. So you touch it to the ATM, and it's just a hypothetical scenario. But you touch it to the ATM, you say, I want 10 rupees to be transferred, and 10 rupees actually gets transferred into the app. RBI is in fact working towards the interoperability of the existing tech stack of the UPI. So where all the transactions happen online with India, CBDC, which is digital rupee, and you know which country is actually ahead in this race. It's China. So check out this image. So China's main reserve is 10.47 trillion yuan, and their CBDC reserve is 13.61 billion yuan. So this network covers 26 cities. It has wallets that are eventually outsourced to VBank and by WeChat and My Bank. It has 10 million plus digital wallets, and their experiment has been run on 0.13% of the population. India, on the other hand, started their digital rupee experimentation of the CBDC experiment in December 2022. The pilot took place in 4 cities, 8 banks, and has over a million wallets. The users can do both peer to peer, which is P2P, and random users interacting with each other. And the second being P2M, which is users interacting with the merchants themselves, which is peer to merchant. Now I'm sure there's something that's been bubbling in your head, which is why all this janjat? We already have UPI in India, right? So UPI is great. Why do we need another system? And here is where it gets interesting. So let me tell you why UPI is very different from CBDC. In fact, the RBI governor made a very clear distinction between the two. In CBDC, you will draw the digital currency and keep it in your wallet on your mobile. When you make a transaction at a shop or to another individual, it will move from their wallet to your wallet. Just like I hand you this note and you take it in your hand, and it's off the books, it's off the records. But it's very convenient. You can do it offline. You don't need the internet. And this is what CBDC does. There's no routing, there's no transaction fee. When I send it from me to you, I am just giving you this note, and there is no intermediation of the bank. So this table shows you the difference between CBDC and UPI. They're not the same thing. UPI has been around for a while, CBDC is new. And they're two different things. CBDC transactions are instant, just like I hand you this note and you walk away. It's instant with UPI. Even though the transaction reflects immediately, the settlement time is actually 1 to 2 days. It's almost like the app provider and the private bank are giving you temporary liquidity till the settlement happens on the back end. And CBDC is a digital tender, while UPI is actually a payment protocol. This is this tender. The only thing is that's going to happen on the phone. The uptime of both is 24/7. CBDC has no intermediaries. You don't need anyone in between to give a note to someone else. And it's the same thing with this technology that you tap two phones, it's done. So the transaction can be sent with UPI. There's a commercial bank involved in the middle verifying these transactions, and the liquidity of CBDC is guaranteed by